Hi, Jennifer. Hello,
Hey.
everybody. My name is Lauren Poindexter. I am a sales consultant with Hovnanian Homes, and today I have my teammate, my partner, Jennifer Borunda with KHAM, which is Hovnanian American Mortgage. And today we're going to specifically talk about down payment assistance programs because I think with all the changes that are going on, people are probably going to want to utilize this a lot more than instead of digging into their retirement or digging into some of their savings to get assistance for their down payment. Well, let's just start. Can you give me a little bit of overview of I know we're going to be specifically talking about down payment programs for Texas because we don't know what's going on.
Right.
Okay. So are we still seeing those are still reserved?
Very popular.
Okay.
Yeah, they're great programs. So there are income restrictions or income limitations on the programs, but if you fall within that guideline, then it is absolutely a wonderful resource to have. And it also right now is helping with buyers that have a little bit lower credit score. So right now the minimum credit score requirement is at 620. But if you fall within that 620 guideline, and I will say this is as of right now, it's April 15th. So this could change, but right now the minimum credit score requirement for this particular program is at 620. And you have to be a first time home buyer, or you cannot have owned property in the last 3 years. There's several down payment assistance programs that are on the market. Some are a little more popular than others. But there are programs for firefighters, teachers, police officers, for our first responders that are out there. So when I typically talk to a client, I'll say, let's get the background, get the information, and try to find which program works best for you or your family's needs, and then go from there. So the firefighter, first responders, Homes for Heroes program is a down payment assistance program with our first responders. You still have to meet the first time home buyer requirements, and you still have to have the 620 credit score. The income limits are pretty standard across the board. For an individual or a couple, family of 2 or more, the income limit right now in Houston, which is Chambers, Fort Bend, Galveston, Harris, Liberty, Montgomery, and Waller counties, is $76,300 per year. I'm referring back to my chart just to make sure.
And that's one person, or that's combined income?
Combined income. So if, let's say, a married couple, one works, one doesn't. So that's a family of 2 or more, or an individual, so a single person. If you have a family of 3 or more, so a couple with a child or a single person with 2 or 3 children, then the income limit goes to $87,745.
Okay.
So it does give you a little bit more room there.
Are there other programs? Because, with inflation, we know that a lot of people are making way more than that. Or people are putting in, particularly first responders, Home for Heroes are putting in overtime. They're
right.
A lot of people are just kind of breaking 6 figures these days. I mean, are there any programs that will have a higher income cap that can be utilized by anybody, not just heroes?
There are some programs that will allow for you to have about $100,000 a year in income. With those programs, though, the interest rates, there's one in particular right now, the interest rate on that is running at about 5.25, I believe, the last time I looked at that, and I'll double check it. So these particular programs are typically more so geared towards the true first-time home buyer programs with a little bit lower income. So I do see more people, let's say a mother or a father, a single mother, father with 1 or 2 children, or let's say 2 or 3 children. That's where we fall into the $87,745 income limit. So it does kind of expand there. Now, I will say that there are some, because sometimes people are not necessarily first-time home buyers. So there is another program that they just opened up where if you're not a first-time home buyer, you can still take advantage of the program, but the income limit on that is even lower at $61,680.
Okay, but
So
you can't own any other real estate, and you can't have owned a real estate in the past 3 years.
so that for the 61,680, you can have owned real estate in the last 3 years, but for the 76,300 and the 87,000, you cannot have owned real estate in the last 3 years.
Okay, and then I know, so right now where the interest rates are kind of between like 3.5, 4.5. That's going to all be that's going to be a variable based on like your individual file, like what your credit score is, what your DTI is. But what we see with some of the down payment assistance, it bumps up the interest payments to 5.2. I want to kind of give a little bit of perspective or clarification around that, because that's still a good interest rate. I mean, at the end of 2018, we were in the fives.
Right.
So it's not the best interest rate for what's going on in the market, but it's still, it
gives you the opportunity. Right. It gives you an opportunity to have less out of pocket. And, if you're concerned about trying to liquidate something or hold on to more money at this time, it is a good opportunity to keep some money in your pocket. I will say with some of the down payment assistance with the lower income, because it's really great for like our teachers and things like that. Right now, their interest rates, it's kind of a reverse market. Right now, the interest rates on these particular programs are actually, depending on how much assistance you need, you can do as little as 2% down payment assistance, and that offers right now about a 3.25% interest rate. So it's actually a really good rate. And then there's one with a 3% assistance, and that's a 3.75% rate, and then 4% assistance, and it's a 4.25% rate.
So basically,
so
the
really,
more assistance you need, the more the rate tax on to the interest. But that 3.25, I mean, that's a good interest rate.
Really good.
One of the questions I have, so if somebody was to say, well, I want to get all of my down payment, I want to go all the way up to 3.2, 3.5, and I'm at the 5.2 interest rate, right? Can they refinance out of that, or do they have to go with that for a certain amount of time before they can refinance to a lower interest rate after they've closed?
Sure. So that's a great question. Some of the down payment assistance programs, like this particular one, is the TDHCA, which is Texas Department of Housing and Community Affairs. That's the interest rate options that I just gave you. For that, this is the one with the lower income limits. So this particular one, if you sell the property, refinance the loan, or pay off the loan, you do have to repay the assistance amount. Some of the programs, so the positive thing with that is it gives you an opportunity to move into the house with zero, very little money out of pocket. Now, the other options where you can do a true grant with no repayment required, those typically do have higher interest rates. So when we call and we talk to a prospective customer, then we'll say, okay, how long do you think you're going to be in the home? Let's talk about statistically, first-time home buyers are typically in a home 5 to 7 years. And then we'll look at, there are programs out there like an MCC tax credit program, which is a $2,000 annual tax credit. So I'll talk to them about that and see, okay, can we add a tax credit program? Maybe look at paying down the mortgage sooner. So then it's not really going to be as much of a concern about paying it back at the end. Or does it make more sense for you to go with the higher interest rate option where it's a true grant, no repayment required? So it's kind of an individualized approach to find what works best for that borrower. And then I will counsel them and say, okay, this one has this, lower interest rate, but requires repayment. This one doesn't require repayment, but the interest rate's a little bit higher. Go over the payment differences and all of the options that are available.
Now, can you use the down payment assistance programs for any loan classification, whether it's conventional or FHA? Can you apply this down payment program for any kind of loan?
Sure. So this particular one, the TDHCA is FHA. There are conventional options that are on the market. The interest rate on those are a little bit higher. There's Seth, which is Southeast Texas. So those are more geared towards conventional. Now, I will say TDHCA T-Shack. These are all acronyms for different down payment assistance companies.
Mhm.
They do change their guidelines regularly. So typically their income limits stay about the same, but like TDHCA up until a couple of months ago only offered a 4% assistance option. Now they're coming in and saying, okay, we'll do 2% for a lower interest rate, 3% for a lower interest rate. Then they do make changes with conventional, but there are conventional options and there are FHA options. There's also options for VA. So they typically can work with any program.
Now, how does it work when, okay, let's say they went with a conventional. Conventional's down payment, just down payment. So FHA requires a 3.5. Some conventional, depending on your income, requires like a 3% down payment, but your down payment assistance may be 4%. So it's clearly more than what you need for down payment. Can that difference be applied to your closing costs, which is separate?
It can. It can. Okay. So typically what we do, if we have a buyer that's looking to get into the property with as little money out of pocket as possible, we will have a combination of seller credit towards closing costs and the down payment assistance. And then when we combine those two, it gives us to a very minimal out of pocket cost.
Are there cases, I know that a lot of lenders, maybe even particularly now with the COVID, or that the investors want people to have skin in the game. Are there situations where people can kind of get in for nothing?
There are. So you can get up to, so let's say if your earnest money deposit is $2,000, you can get up to that $2,000 back. You can't get anything additional back.
Yeah.
But yes, we do have customers that will get into the property with very minimal out of pocket.
And basically will be reimbursed their earnest money deposit.
Right. Or part of it. Correct.
Yeah. Okay. And I've had that happen. I'm just not sure if that's happening still within the time. Okay.
It is. Yes.
And then one of the questions that I had was when we discussed, is there any other programs that are more than 4%? Because honestly, if we're looking at down payment with the combination of closing costs, really that's almost up to 6% of the sales price. So we're still being a little short at 4%, or would the seller's contribution need to make up that?
Typically the seller contribution would, so typically it'd be about 4% for the down payment assistance, and then the seller credit would cover the difference. Off the top of my head at this exact moment, I can't think of another one that has a higher down payment assistance, but they do change all the time. So typically what I do when I have an applicant come in and say they're interested in down payment assistance, then I'll look at the guidelines. I will actually go while I'm on the phone with them and look at all the different program guidelines right then, because they do change so often. So I'll look to say, oh, look, this one's offering a 2% assistance and a lower interest rate, or this one is offering more. So we'll just kind of go through those and double check to see what's changed.
Okay. And I know that you have mentioned, I know there's a lot of changes in the qualification criteria just across the board for particularly any Fannie Mae, Freddie Mae loans. And so we're at the 620, where before we were at 580. Did the down payment assistance programs, were those requirements 580 as well, and now they've up to 620?
So we had some that were at 600, and right now they're pretty much across the board at 620. Some of the down payment assistance companies increased to 660. TDHCA specifically is still at a 620 requirement. So that is a little bit fluid right now, but TDHCA has been pretty consistent, 620 for the last couple of years.
Okay. So just to be, and I always tell people anyways, when they're asking me, well, what kind of credit score do I need? I'm like, to be safe, just 620,
Right.
Especially when they're particularly first-time home buyers who may just not have credit. So they're not at the 620, not because of anything derogatory, but they just haven't built their credit. They're starting life off, So that is something definitely for the consumer to kind of look out and just be at the 620. And then is there, I know that you were saying if you refinanced or sold a house or within a certain time frame, you do have to pay some of these grant programs back. Is there a minimum time that you have to be?
So for TDHCA, it's when any time. So whenever you sell, refinance, or pay it off, it would have to be required to be repayment. With Seth Gold Star program, there are options for a 5-year repayment, a 7-year, and a 10-year. So typically, if it's a shorter repayment, the interest rate would be a little bit higher. If it's a longer term, then it would be a little bit lower. And then there's some that are just true grants with no repayment is required. But typically with that, those are going to be the options with the higher interest rates.
Okay, and then one of the grant programs you just mentioned where you had the 5, 7, and the 10, you were saying repayment. So they're rolling that in, you're paying a little bit, they're rolling that in.
So there's no, sure. So let me clarify that. There's no monthly repayment requirement, but if you sell the property within 5 years, it's like a sliding scale. So it goes down each year. And then if you are like 7 years, so you sell it in the first year or 2 years or 3 years, it's going to reduce. So it's just the amount of money that has to be repaid goes down every year.
Okay. And then is there somewhere, if people just were kind of wanting to do their own research, is there a place where people can go to look at these?
There is. You can go to myfirsttexashome.com. That is one of the options. And I'm trying to think. My First Texas Home is for TDHCA, and there's Seth, Southeast Texas Housing and Community Affairs. And I'm trying to think, but My First Texas Home is the first one that comes to mind right now.
Okay. And then I know we don't, like, people just kind of shy away maybe because of the higher interest rates or it just seems sometimes like it's complicated. These can be complicated. I mean, are you seeing that they're complicated? Is it a lot more legwork? Are the closing times a lot longer for these programs, or?
They're really not. So some of the programs will take a little bit longer. TDHCA is not longer at all. It is something that we do internally. We print all the papers, and they do have to take a first-time homebuyers class that can be done online. But for the most part, they're really pretty seamless. And so I always kind of think of it as a large pizza, right? So you don't eat everything all at once, but we just take one step at a time, and we will absolutely help guide you through everything. When I typically talk to a buyer for the first time, first of all, they're first-time home buyers, so that is, learning the process and how everything works. So I'll go over everything by phone, send a follow-up email with all of the details, and then schedule a call after that to go through that again once they kind of had a chance to absorb some of the information. Then we send everything out to them through the online portal for them to electronically sign, and then we go over that with them again. So we are here to help every step of the way, and just really here to, make sure that everybody understands what's going on and can kind of understand not only how to, let's say if you're doing an MCC tax credit, which is a tax credit that you'll get annually. So there's down payment assistance, first-time homebuyer class for that, and then also for the MCC. So they know what to do with that MCC certificate after closing. So there's going to be follow-up information and reminders, and then emails that go out to them as well.
Okay. And then, and we're going to be able to close those programs just like we would close a regular.
Correct.
Okay. All righty. Well, I think that there was one other question that had came to mind, but it just escaped me. And I was like, oh, I need to know this. But, I do know what the question is now. So usually if you weren't getting any down payment assistance programs, you would pull a bank statement, you would look at their savings, or you look at their retirement and make sure that they have enough cash reserves to qualify for the closing. In cases where pretty much their closing costs and down payment are going to be covered by the seller and the down payment, so they may be coming out of pocket with nothing, do they still need to have that required savings as if they weren't getting those contribution?
So typically the answer would be no. I would say if they have like a higher debt ratio percentage, what's coming in versus going out, then sometimes we may say, okay, we need to have 2 months in reserves, but that would not be typical. Typically we would just say you wouldn't need to have reserves. It's always good to have them. But let's say if there's something that may be a little bit more higher risk, we're only using one, like say only using the husband's income and credit for qualifying and not the wife's, but really we know that as a family make more money and they're going to be able to handle the housing payment. But from an application standpoint, it looks like, goodness, if they get into trouble, they may not be able to make the payment. So if it looks like a higher risk loan on paper, sometimes we'll say, okay, you need to have 2 months reserves, but I would not say that that's going to be the norm.
Okay, and I always tell people 6 months reserve. Am I being aggressive with that? Like, was that a standard, or is that still a standard for some loans? 6 month reserve?
Not necessarily. I mean, I think it's a good idea. I think it's a good idea to have a fallback in case something were to happen, but it is not necessary.
Okay, it's not required for a loan. So, and then just to kind of give clarification on what we mean by reserves, we're talking about when we say 2 months worth of expenses, we're saying you need to have the mortgage amount in there, you need to have the tax amount in there, and you need to have the insurance amount in there. So
right.
If your mortgage is $1,000 and your taxes are $500 and your insurance is $100, you need to have $1,600 per month.
Right. So that'd be $1,600 would be 1 month reserves.
Yeah.
And then 2 months, etc. So yes.
Yeah. Okay. All righty. Well, that is good information. I thank you again, Jennifer.
Thank you, Lauren. I appreciate it.
I appreciate it.
Let me know if you guys have any questions, and we're looking forward to helping all of the new buyers.
Okay. And then if somebody wants to reach you, just your office number and email, and even though you're working from home. Okay.
Right. I'm working from home, office phone number and email, and then my mobile number. So yeah.
Okay. Now, is it okay if I post that in
yeah.
Here? Okay.
Perfect.
All right. Thank you.
Thanks, guys. Have a good one. Bye-bye.